Welcome to this walkthrough. I am genuinely excited you're here today because we're about to launch what I like to call a very targeted and absolutely essential financial rescue operation. Now, if you have a pension, I need you to tune in and pay extremely close attention. Much of what you've seen in traditional retirement guides is flat out inaccurate. Honestly, the famous 4% rule, basic withdrawal strategies, common tax tips, they were never designed with you in mind. If you have a pension, the IRS actually handles you very differently from most other people in retirement. You're treated differently than someone who only has a 401k and differently than someone relying entirely on Social Security benefits. And the reality is, very few people, including many experienced tax professionals, fully grasp what this really means for the taxes you'll owe. So today, we're going to completely dismantle the pension tax illusion. To understand why so much guidance misses the mark, just look at the statistics. Only 14% of private sector employees still have access to a genuine traditional pension plan today. Compare that with the public sector, where roughly 86% of state and local government workers are covered. So, if you're watching this walkthrough and you've got a pension on the horizon, or you're already receiving one, you belong to a very small, very specific, and deeply misunderstood segment. You're practically a financial unicorn. The advice industry generally doesn't tailor its mainstream strategies to a 14% minority because, frankly, there isn't enough profit incentive to build mass market guidance for that group. But today, we are tossing that generic playbook aside and we're putting real numbers on the table. All right, let's get into it. Here's the agenda for today. We're going to talk through number 1, the pension tax reality. Number 2, the Social Security trap. Number 3, RMDs and Roth conversions. Number 4, hidden Medicare surcharges. Number 5, the lump sum versus monthly decision. And finally, number 6, your updated retirement framework. Let's jump straight in. First up, trap number 1, the pension tax reality and why where you live is crucial. One of the biggest myths floating around is the belief that your pension will be totally, or at least largely tax-free just because you contributed during your career. Let's clear that up immediately, okay? For most employer-funded pensions, every dollar you receive in retirement is fully taxable as ordinary income at your federal marginal rate. It is not taxed at those lower, more favorable capital gains rates. Instead, it's taxed exactly like your paycheck used to be. And here's where things get especially interesting. Geography matters more for pension recipients than for almost anyone else. Individual states treat pension income in dramatically different ways. For instance, if you live in Pennsylvania, Illinois, or Mississippi, guess what? They don't tax pension income at all, 0%. States like Florida and Texas already have no state income tax whatsoever, so you're clear there too. But then you've got New York, where only the first $20,000 can be excluded, and that's only if you're over age 59 and 1 to 2. Anything above that, fully taxable. Or look at California, where pension income is taxed at the standard state income tax rates, which can climb as high as 9.3%. Let's put that in concrete terms for a moment. Suppose you receive a $40,000 per year pension. Living in California rather than Pennsylvania can cost you around an additional $3,700 annually. Over a 25-year retirement, that's about a $90,000 gap. $90,000 for the same lifestyle, the same pension, just because of your address. That brings us to our next key problem, and I want to ask you this directly. Did you realize that your fixed pension could be nudging your Social Security benefits into the zone where up to 85% becomes taxable? Most people are completely unaware this is happening behind the scenes. It's a subtle snowball effect that gradually reduces the real value of the Social Security benefits you spent decades earning. Let's walk through exactly how the IRS calculates this, which brings us to trap number 2, the Social Security trap and crossing those thresholds. Having a pension permanently alters the way your Social Security is taxed, especially compared with your neighbor who might only have a 401k. The IRS relies on a specific and frankly very rigid formula to determine this. It's called provisional income. Provisional income is defined as your adjusted gross income plus any tax-exempt interest you receive, plus exactly 50% of your Social Security benefits. That's the whole formula. This is the calculation the IRS uses to determine how much of your Social Security could be taxable. And here's the crucial detail almost no one talks about. Your pension income is fully counted toward this provisional income, dollar for dollar. There's no special carve-out, no unique deduction. It all shows up in the math. Now consider this. These income thresholds were put in place back in the 1980s and 1990s, and they have never been indexed for inflation. Not once. So if you're married filing jointly and your provisional income exceeds just $44,000, up to 85% of your Social Security may be subject to tax. And because your fixed pension is counted from the very first dollar before you even withdraw from an IRA, pension holders are almost guaranteed to land in this 85% taxation zone. Let's run a quick scenario. Imagine you have a modest $30,000 pension and a $24,000 Social Security benefit. Your provisional income immediately starts around $42,000. Think about that. Think. You haven't even tapped any investments yet, and you're already facing significant taxation on your Social Security. Someone without a pension can simply lower their IRA withdrawals to stay under these lines. But with a fixed pension, you can't simply shut off that income stream. You're boxed in. Next, let's examine trap number 3, RMDs and Roth conversions, specifically the missing gap years. What's fascinating here is how this completely inverts standard advice. Many traditional retirement voices say Roth conversions are mainly about locking in a lower tax bracket early in retirement. But for someone with a pension, your approach depends on what I call the gap year concept. For a typical retiree, the most advantageous time to do Roth conversions, shifting funds from a pre-tax IRA to a Roth IRA, is usually those low-income years after they retire and before they hit age 73. But if you're a pension recipient, you don't get those low-income years. The moment you retire, your pension payments begin, and your income floor stays permanently higher. You're effectively locked into an elevated marginal tax rate for the long term. So you might be wondering, why even bother with a Roth conversion? Because it's often your main protection against a forced withdrawal problem later on. You need to see the compounding impact of required minimum distributions, or RMDs. When you turn 73, the IRS requires you to withdraw a certain percentage of your traditional IRA every year. There's no opt-out. Those mandatory withdrawals stack right on top of your pension and your Social Security benefits. For example, suppose you have a relatively modest $400,000 IRA. At age 73, you're required to withdraw about $15,000. By age 80, that required amount grows to around $25,000. By age 90, you might be forced to take out more than 12% of the remaining balance. Suddenly, you can find $60,000 to $70,000 of fully taxable income showing up on your return every year, whether you need the money or not. So for pension holders, a Roth conversion isn't really about hunting for a rock-bottom bracket today. It's about locking in a known tax cost now, so you can shrink that IRA before RMDs create a very large tax burden when you're in your 80s. Now let's move to trap number 4, hidden Medicare surcharges, often called the IRMAA cliff. When you start making deliberate tax moves such as those Roth conversions we just discussed, you absolutely must be aware of this hidden threshold that surprises many retirees every year. It's called IRMAA, short for Income-Related Monthly Adjustment Amount. It's a technical term, but in practice, it's an additional amount added to your Medicare premiums once your income exceeds certain preset tiers. If you're a married couple filing jointly and your income rises above a given threshold, let's say somewhere near $218,000, your standard Medicare Part B premiums don't just inch up slightly. Instead, a typical $22.90 monthly premium can jump to well over $600 each month per person. And because your pension already creates a relatively high fixed income level, a seemingly normal-sized Roth conversion can unexpectedly push you over that IRMAA line. Here's what makes IRMAA particularly tricky: the 2-year look-back rule. This is how it catches people off guard. Suppose it's 2026 and you complete a well-planned $40,000 Roth conversion in 2027. In 2028, your Medicare premiums can rise by thousands of dollars. That's because the government uses your income from 2 tax years earlier to determine your current Medicare costs. As a pension holder, every single financial move you make needs to be reviewed with one eye, always on your federal tax bracket, and the other eye on those Medicare IRMAA ranges. It's this two-sided calculation that many basic tax tools won't highlight clearly until the higher premiums are already in place. This leads us to trap number 5, lump sum versus monthly pension benefits, and the massive tax flexibility question. This centers on what may be the single most important, entirely irreversible financial choice you'll make as a pension recipient. Do you opt for the lump sum or the ongoing monthly payment? Many commentators treat this almost purely as a rate of return puzzle. They ask, can you invest the lump sum yourself and outperform the guaranteed monthly checks? But that framing misses the real issue. The heart of this decision is tax control and flexibility. Consider it this way. If you take the monthly payment, you gain tremendous peace of mind. You receive guaranteed income for life with no market volatility risk. That sounds fantastic. But you sacrifice virtually all tax flexibility. Those payments show up as taxable income every single year, and you cannot pause them. If instead you choose the lump sum and transfer it into an IRA, you gain full control over timing. You decide when to withdraw money, you can manage your provisional income for Social Security, and you can reduce the chance of crossing IRMAA thresholds. But in return, you take on investment risk and the risk of outliving your assets. The lump sum only truly shines if you are committed to actively, carefully managing the tax timing of your withdrawals for the rest of your life. However, there is a lesser-known middle ground, the hybrid approach. Some pension plans let you take part of your benefit as a monthly payment and the rest as a lump sum. This can be an incredibly strategic compromise. It's like combining the strengths of both options. You can set your monthly pension high enough to reliably cover essential expenses such as housing, groceries, and utilities. Then you roll the remaining portion into an IRA, keeping meaningful tax flexibility for your discretionary spending. A surprising number of retirees aren't even aware this is available. You should absolutely contact your pension plan administrator to ask whether a partial lump sum option exists for your situation. It can fundamentally reshape your strategy. Now we arrive at Section 6, your updated retirement framework, and the idea of asset-liability matching. We've highlighted the major traps. Now let's focus on a practical solution. If the classic 4% withdrawal rule doesn't apply well to you, what does? You need to align your fixed essential costs, the absolute must-pay bills for day-to-day living like housing, groceries, utilities, and basic insurance, directly with your reliable income sources, meaning your pension and Social Security benefits. The key insight is this. If your pension and Social Security together cover your basic living costs, it completely changes how you should think about your nest egg. It means your 401k or IRA is no longer funding your survival. You can use those accounts for your goals and extras, such as travel, a new vehicle, helping family, or leaving an inheritance. Your pension becomes the engine of your financial stability. It is your huge safety net, and that shifts your investment accounts from being a worry-driven, must-not-lose pool into a more opportunity-focused growth engine. This also explains why your investing approach may look very different. A redesigned portfolio for someone with a pension doesn't resemble the standard blueprint. The average retiree is usually told to hold a fairly cautious mix like 60% stocks and 40% bonds, or even 50-50 to protect steady income. But in your case, the pension itself effectively behaves like a massive built-in bond allocation. Let's look at a concrete scenario. Picture a 66-year-old couple. Their essential living costs total $68,000 per year, yet their combined pension and Social Security provide $76,000 annually. That means they have an $8,000 surplus before tapping their $450,000 401k. Because their day-to-day stability is already guaranteed, they don't need to load that 401k with large amounts of low-yield bonds. They can reasonably adopt a more growth-oriented mix, such as 80% stocks and 20% bonds. If the stock market were to fall 30% in the short term, their basic lifestyle wouldn't be in jeopardy. They might just delay a big trip or a discretionary purchase. Pension recipients have the rare ability to invest more assertively because their foundation is already secure. But as we talk about protecting that foundation, I need to flag a serious potential problem involving your spouse and how you set up the pension. At retirement, you're often required to choose between a single life benefit, which pays the highest monthly amount while you're alive, or a joint and survivor benefit, which pays somewhat less each month but continues income for your surviving spouse. Many people pick the higher single life benefit because it looks more attractive right now. But here's the difficult reality. After one spouse passes away, household expenses usually only drop by about 25%. Think about it. The mortgage payment, utility bills, and property taxes mostly remain the same. Yet if you selected the single life option, your total household income could fall by more than 50%, because one Social Security payment disappears and the pension payment can also stop entirely. You must always analyze the survivor gap. The joint and survivor choice functions as crucial protection for the later years of your spouse's life. There's also another powerful reason your investment accounts must maintain meaningful growth potential: inflation. It's the quiet, long-term threat to any fixed pension. Most modern pension plans do not include an automatic cost of living adjustment, or COLA. So if you secure a $36,000 annual pension today, you're still getting $36,000 in year 10 and $36,000 in year 20. But at a historical average inflation rate of around 3%, watch what happens to your buying power. By year 10, that payment feels more like $27,000 in today's dollars. By year 20, your $36,000 pension only purchases what about $20,000 would buy right now. It's a gradual, largely invisible reduction in your standard of living. This is exactly why that growth-oriented 401k or IRA strategy is so important. It's not primarily about luxury. It's a key component of long-term financial security, serving as your main protection against rising costs when your fixed pension no longer stretches as far as it used to. Which leads to one last crucial question for you to reflect on. Will you allow default tax rules to gradually reduce the value of your pension, or will you proactively shape your own financial strategy? If you have a pension, the costliest error you can make is staying passive and assuming everything will naturally work out. The IRS is not going to notify you that you're paying more tax than necessary. So here's a concrete action checklist. First, confirm your actual lump sum and partial lump sum options with your pension office. And just as important, schedule a meeting with a fee-only financial planner, not someone primarily focused on selling investment products, but a planner who really understands the specific tax dynamics of pensions. Ask them to map out your next 20 years, not just your plans for the next couple of years. You hold a major financial advantage by having a pension, but that advantage only pays off if you navigate these issues thoughtfully. Thank you for spending this time with me on this in-depth walkthrough. Take charge of your plan, safeguard what you've earned, and I'll see you in the next video.